A while back, we did a YouTube short in which we talked about the Magnificent Seven and how expensive they were. Well, a lot's happened since then. NVIDIA has absolutely skyrocketed in terms of its price as well as its cash flow. It crushed numbers. So here we are, and we're going to go back and reevaluate it. Now, this is a high-level metric, but I want you guys to understand that I like to engage the conversation here. So if you could, and you're interested in talking to me about this, follow me on Twitter. I'm very active, as you can see. I like to talk about these metrics. I like to talk about things that matter in the investment world. We're going to talk about the price to free cash flow. Historically, it's been around 15 or 16 for the market. But you should pay more for fast-growing companies with high returns on the money that they invest in their business, right? Because if a company can reinvest in its own self and generate higher profit faster, obviously you should pay more money for it. Of course, correct? Great. So back then, the price to free cash flow on the top 7 companies was about 46. This is the Magnificent Seven: Apple, Microsoft, Google, Amazon, NVIDIA, Tesla, and Meta. This is their free cash flow for the last 12 months, a total of $275 billion. And their market cap is actually the same as it was. It was about $11 trillion the last time we did this YouTube short. It's still about $11 trillion. But now the free cash flow is higher. For the price to free cash flow of about 40, still expensive. Now, does that mean because these companies have great future and revenue and all these things that you should pay whatever price? Of course not. That's the difference between an investor and a speculator. A speculator focuses on the story, and an investor tries to merge the story with the numbers. There is a price that's too high to pay for anything in this world. Anything in this world besides maybe life or death. And even then, I'm sure a lot of actuaries would make an argument that life and death has a value to it. Of course, there's a whole movie that was done about 9/11 in which they hired the law firm and the insurance company to determine the value of a life. And it's a kind of a morbid thing because you're talking about people's lives. But at the end of the day, that's what these guys do. But here, we're talking about companies. And companies have value. Companies are going to generate cash flow. Every investment is the present value of all the future cash flows it generates. Okay? So if you have a stream of $1 a year for the rest of your life, that's worth something today, depending on what return you want to make. The more return you want to make, the less you can pay for it. And the faster that cash flow is going to grow, the more you should be willing to pay for it today. So what makes this 40 times free cash flow, which is almost 3 times more than the market average, what would make it worth it? Well, let's draw some scenarios here. $275 billion. If I told you tomorrow that the cash flow is going to double to $550 billion and grow from there, would you pay 40 times? I absolutely would. I wouldn't even blink an eye. If I knew that $550 billion was the absolute low and it was just going to grow from there at 10 or 12% a year, even 7% a year, I would absolutely pay that. Okay, great. Now, let me ask this question. What if I told you that NVIDIA's free cash flow of $10 billion was based on AI, and in 2 years, it might not go very well and it might drop in half? Would you pay that now? I don't know. This is selling for right now 100 times free cash flow. This is 100 times free cash flow. 115 actually. Is it reasonable? Is it not reasonable? We won't know until the future. The biggest mistakes I've made in investing is not paying enough for future growth potential. And I've learned that mistake, and now I'm starting, if you see my videos now versus 3 years ago, the difference I have now is I'm willing to pay a premium for better companies with an ability to grow and protect their free cash flow. It absolutely is important for every investor to understand that. It's important. It's the Philip Fisher way of investing. It's the way that Warren Buffett changed into once Charlie Munger entered his life. You should be willing to pay more for a quality company with stable and growing free cash flow. But how much more is the question? That's the question that differentiates a speculator with an investor. As Professor Oswas always says, a story without numbers is a fairy tale, and numbers without story is an Excel sheet. Well, we have an Excel sheet right here. But guys, every single one of these companies, I think, have a great story, have an absolutely great story. The future looks bright for all of these. Now, some of these are going to grow faster than others based on where they are. Like, I personally believe Tesla is going to be one of the fastest growing companies of these 7. Tesla and NVIDIA will probably be the fastest growing. Isn't it ironic? They're probably the most overpriced ones. Their metric here, Right here, and NVIDIA is 110 times free cash flow, and Tesla is 120 times free cash flow. The story gets people to pay more. But the question is, are they right? The market tends to be wrong overall. Apple is 28 times free cash flow. Still a lot, still high, but is it stable? They have high returns on their capital, but they can't reinvest at high rates of return right now because they're already so big. $2.8 trillion company with $100 billion in free cash flow. Guys, their free cash flow per year is 3 times higher than NVIDIA generates in revenue and over what Tesla generates in revenue per year. And they generate that just in free cash flow. So remember, free cash flow is cash from operations less your capital expenditures. It shows what's left at the end of the day to buy back shares, pay down debt, make acquisitions, invest in yourself, and pay dividends. Those are the 5 major things you can do with free cash flow. That's why it's so important to look at this metric. It's the lifeblood of a company. If you tell me this is a reasonable price, great. Is 50 times reasonable? Because the story is still the same. If you're focused only on the story, then add 3 more zeros to this. On value, is the story still the same? The story is still the same. That's what makes it not an investment. If you merge the two together, free cash flow and the value, and you look at the story, then you start to understand, okay, how much is too much for this? Because at the end of the day, what they're going to make is what they're going to make. We don't know what that is. We don't know the future, but we can make assumptions about the future. That's why our stock analyzer tool is such a popular tool. It allows us to make assumptions about the future, low, middle, and high, and it'll spit out, based on those assumptions, what we're going to have to pay for the company today to get the return we want. And remember, the very first line is revenue growth. I always love it when I hear people say, oh, Paul doesn't get revenue growth. Paul doesn't get growth. It's the very first line of my stock analyzer tool that I use every single day. Of course I understand growth. The difference is I'm not willing to overpay for growth. And the other thing is I could very well just be too conservative in my growth estimations, which I'm guilty as charged. But my goal isn't to make investments based on the rosiest of rosy assumptions. My goal as an investor is to be patient and wait for the right opportunities to come about where the market might be mispricing things. Everybody sits there and says that they want stocks to fall and they'll be buyers. But really what's going to happen is if Apple fell in half today, the story would follow the stock price. The story would change from Apple is dominant to here's how Apple is losing its edge. All of these companies today, if they fell in value from 11 trillion to 5.5 trillion, literally in half, the story would all change about how they're all terrible companies. Look at Google. When Google was at $83 a share, it's at $135 now. When it was at $83 a share, the story was how they're laying people off because they're losing their edge. There are other companies, other search engines out there, they're not doing a good job. Now all of a sudden they're back to 135, and now Google's back, baby. Guys, that was less than a year ago. That was less than a year ago. So if this makes sense to you, subscribe to the channel. This is what we talk about all the time. There are stories in which it makes this a very justifiable price. The question is it reasonable to make the assumptions that justify 40 times the free cash flow? It very well could be, and that's what makes investing an art. Thank you very much, guys. Subscribe to the channel.